I'm a certified financial planner and portfolio manager managing millions for high-income professionals. And I'm about to tell you something that will genuinely upset every advisor in your network. The advice they're giving you, it's designed to keep you average. My name is Alvin Yam. I run Paraiba Wealth, a fiduciary RIA focused on building concentrated portfolios for people who don't want to wait until 65 to retire. And what I do with client money is the opposite of what most financial advisors preach. In the next 8 minutes, you'll see why the standard 60-40 diversified portfolio could actually be a trap for some, how the ultra-wealthy actually build wealth, and the exact framework I use to help clients potentially retire 10 plus years earlier than their peers. Let's jump into it. Here's what most advisors tell you. We'll build you a broadly diversified portfolio. We'll allocate across broad index funds. Play it safe. Stay invested all the time. Set it and forget it. We don't pick stocks, that's too risky. And when markets get rocky, don't worry, we'll ride out every downturn together. Just stick with the plan and things will recover eventually. Sounds smart, right? Sounds responsible. But you need to ask yourself, why is this the only advice the industry ever gives? Is it because it's best for your wealth? Or is it because it's best for their business model? Here is the dirty secret of the wealth management industry. Advisors don't diversify to protect you. They diversify to protect themselves. It comes down to three things: liability, scalability, and career risk. First, career risk. There is an old saying on Wall Street: it is better to fail conventionally than to succeed unconventionally. If your advisor puts you in the S&P 500 and the market crashes 20%, they don't get fired. They just point at the news and say, hey, everyone lost money, it's the economy. They keep their job. They keep collecting their fee. But if they stick their neck out, if they concentrate your capital into 15 high conviction companies and it goes down temporarily, you blame them. They lose the client. They lose the fee. So they choose the path of least resistance. Average returns for you means job security for them. Second, it's lazy. Deep research is hard work. Reading 10Ks, analyzing balance sheets, understanding founder psychology, that takes hundreds of hours. Most advisors are relationship managers, not investors. It is infinitely easier to put 1,000 clients into the exact same cookie-cutter model of a dozen ETFs, charge a 1% fee on all of it, and spend the rest of the time on client events and finding new clients. They aren't managing your money, they are managing a sales funnel. And finally, liability. If you own the index, you can't sue them for underperformance. By keeping you average, they are bulletproof. So when you do the math on real returns via this safe path, minus the fees they charge you for doing almost nothing, minus the taxes, and minus the purchasing power you lose to inflation, that safe path isn't building wealth, it's barely treading water. And if you're happy working until you're 65, great for you. But what if you're not? What if you're in your late 30s making good money and you don't want to work another 25 years? What if you want more than average? Because here's the math: average strategy equals average outcome. If you want an extraordinary outcome, like retiring a decade early, you need an extraordinary strategy. The real question is, are you willing to do what most people won't? For me, the answer didn't come from a textbook. It actually hit me in the face by accident. Years ago, when I was working at a large investment company, I met a guy. He was young, and he was sitting on a mid-8-figure net worth. I remember looking at his portfolio and asking, how did you pull this off? He smiled, the kind of smile you have when you know something others don't, and said, I did my homework. I spent hours and hours researching and found the best companies in the world: Berkshire, Microsoft, Qualcomm, and a few other exceptional companies. I bought them. I kept adding. And I retired in my 40s. He didn't say asset allocation. He didn't say index funds. He said, I found exceptional companies. It felt like a gut punch. Here I was, the expert, telling clients to spread their money across 500 different stocks, simply because that's the playbook the industry trained us to follow. And this guy, he was living the dream because he did the exact opposite. He didn't dilute his winners. He bet on conviction. He pressed his advantage until he won. Think about that. I'd spent years preaching the gospel of passive investing. Stay diversified, buy the index, don't pick stocks, stay safe. And here's a guy who retired decades early because he broke that rule. He didn't spray and pray. He concentrated. He invested with conviction. And that's why he is free. And everyone else is still working. And that's when I started noticing a pattern. The people reaching financial independence early, they didn't diversify into oblivion. Look at the ultra wealthy: Buffett, Berkshire; Musk, Tesla, and SpaceX; Gates, Microsoft; Bezos, Amazon; Zuckerberg, Meta; Huang, Nvidia. And before you say those are just outliers, look closer. This is actually true for most ultra-wealthy families across history. You rarely find a family dynasty that got rich by buying the haystack. They didn't diversify their way to billions. They concentrated. Warren Buffett said it best. Diversification is protection against ignorance. It makes little sense if you know what you're doing. This is the secret your advisor won't tell you. So here's how you actually build a concentrated portfolio that compounds real wealth. Number 1, quality over quantity. You don't need 500 stocks. You need 12 to maybe 18 exceptional businesses. Most investors don't realize the shelf life of big companies is shrinking. In the 1950s, an S&P 500 company lasted decades. Today, less than 18 years. Technology now disrupts balance sheets faster than ever. That's why you don't want to be buying everything. Instead, you want to be zeroing in on the handful of businesses that are actually driving transformation. Tesla didn't just make EVs, it forced every automaker to rewrite their strategy. Amazon didn't just compete, it made entire retail categories irrelevant. Nvidia didn't just make chips, it became infrastructure for the AI era. These companies don't react to change, they cause it. Number 2, founder-led conviction. You're not just buying a business, you're betting on the person steering it. Founder-led companies consistently out-execute those run by hired executives. Why is that? Founders are building their life's work, not just climbing the corporate ladder. Just look at what happens when iconic brands hand over the reins. Intel, Starbucks, Nike, Chipotle, Lululemon. Without the visionary at the helm, they stopped playing to win and started playing not to lose. But when the founder's still deeply involved and has real skin in the game, that's not just a detail, it's a powerful signal. Number 3, real growth potential. We're not interested in safe companies growing 3 to 5% annually. Now, look at the math for 3%. At that pace, you're waiting 24 years just to double your money once. But at 15 to 20% annual growth, your money doubles every 3 to 5 years. That gap isn't just a number on a spreadsheet. It's the difference between hoping you can retire at 65 and having real optionality in your 40s. Number 4, deep research, real conviction. Before a dollar goes in, this question gets answered. If this stock dropped 30% tomorrow, would I be excited to buy more or desperate to get out? If you'd panic sell, you don't have conviction. And if you don't have conviction, you shouldn't own it. Number 5, dynamic position sizing. This is where big money is made. High conviction positions deserve real weight. Doubt creeping in, size comes down or goes to 0. Most people spray and pray. But real investors press advantages and cut mistakes fast. Now here's what's important. This isn't for everyone. It's not for people who panic at 20% drawdowns. It's not for people unwilling to do research. It's not for set it and forget it investors. But if you're thinking, I don't want to work until I'm 65. I want a real shot at retiring early. I'm willing to do what most people won't. Then this framework actually works. The question isn't whether you can do this. The question is whether you have the conviction to stick with it when others panic. Here's my recommendation. Option 1, do it yourself. Everything here is doable if you have the time and discipline. There are folks here who will really take this and run with it. Option 2, work with a fiduciary advisor. But be careful here. Most advisors are content to put you in a slow lane. You need a fiduciary who is legally bound to act in your best interest and specializes in concentrated high-growth portfolios. You want a partner who can execute the research and manage the volatility for you. Either way, the principle doesn't change. High conviction beats blind diversification. Strategic action beats passive comfort. Here's the thing. Real wealth requires real commitment. The question isn't whether you can do this. The question is whether you have the conviction to stick with the framework when others panic. If you're ready to stop playing it safe and commit to an extraordinary outcome, you need more than generic cookie-cutter advice. You need actionable insights that actually move the needle. Subscribe now for updates and deep dives into building wealth and investing with conviction. I'll see you in the next one.